In this chart talk, I want to talk to you about two cycles that have been very dominant in both gold and the stock market. The blue line is a 2-year cyclical pattern in gold. That's what we're looking at here on a weekly basis, while the red line is the 4-year pattern. Notice how this low in gold was certainly called by the 2-year cyclical pattern at just about what gold did. Started to come up again with that 2-year pattern. The longer term pattern is a 4-year pattern. We bottomed in here and we went for quite some time. In fact, we'll just go take a look at the next time that pattern occurred. Right here, there's the low in gold and another 4-year move in gold. Pulls back, and then again, we start to see another massive move to the upside in gold. So the long-term moves in gold seem to be pretty much in phase with the 4-year pattern, and in the 2-year pattern are the really accentuated moves in the gold market when it really gets strong. So what does that mean for the future? Well, let's take a look right here. The 4-year pattern topped in the first part of 2012. So did the 2-year pattern. They're both down now. The 4-year pattern really doesn't bottom until late 2014. The 2-year pattern suggests a kick-up rally sometime in the middle of 2013. But in terms of gold making new highs here, are the gold bugs right? Well, hey, in the market, anything can happen. But the 2-year and 4-year patterns, which have been really good guidelines for this market, are suggesting to me that gold is going to be in a trading range, if not down market, until at least the middle of this year, 2013, and that the next big bull market in gold starts down here somewhere in 2014. So expect a trading range, choppy affair in gold, no significant massive run up to the upside like we saw when that 4-year cycle was bullish in gold. Now, let's look at what these same cyclical tools are telling us for the stock market. Again, the blue year is a 2-year pattern, cyclical pattern in this case stocks, and the red is a 4-year pattern. The 4-year pattern has just been so doggone strong in the stock market. I first tumbled onto this somewhere in 1970. It's done an excellent job. The low in 1982, well, there it was, a 4-year cyclical low. This massive run up we saw in 1987, that's exactly when you would expect market to get strong. The 2-year pattern peaked at the same time. We can actually use these two together. Let me show you a little bit more here. The 4-year pattern peaks in 1993, and prices don't really start to rock and roll again until the upside, until, well, when the 2-year pattern and 4-year pattern both suggest a kick up in the marketplace. So looking at those, the last few years, we see the same phenomena. When the 2-year kicks up and the 4-year, this is when money is really made in the market. Remember this in 1999, 2000, the market just seemed to go straight up. And then again in 2003, the market just went straight up, didn't look back at all. Well, look where the 2-year and the 4-year cycles were. They were both saying strong rally, blast off to the upside, and we did. We saw that same phenomena again in 2007, where they're both congruent, saying, and the market just ran seemingly out of control. The question is, where are we now? Well, let's take a little longer term look on that. This is where we are now. We're not in the same place where we were in, say, 2011, where they were both very strong and the market had such a strong run. The 2-year pattern actually peaks out sometime in March of this year and comes down. The 4-year pattern, though, has been down for some time. It suggests a low to come, but not until 2014, 2015. So in terms of a runaway bull market in here in stock, kind of like gold, I don't think so, not based on these patterns. The patterns suggest the next substantial move to the upside in the stock market will come late to 2014. Most likely what we're going to see is a choppy trading range affair. We could make new highs, but a runaway market like this doesn't look like it when we look at the 2- and 4-year cyclical patterns. This is Larry Williams. I hope that's given you some good perspective on the long-term view of the market.